The surface of global finance is projecting a narrative of radical transformation, framed through the lens of ethical necessity. But if we observe the underlying capital stack, a structural mismatch emerges, one that the public narrative is not designed to reveal. While retail narratives focus on carbon footprints and environmental morality, institutional capital is quietly pricing in a far more clinical reality, the weaponization of the ledger. We are witnessing a profound dislocation between the public perception of ESG as a social good and its structural function as a liquidity filter. Major asset managers are not merely investing green, they are recalibrating the very definition of risk-weighted assets. This is not a shift in conscience, it's a shift in the architecture of collateral. When a sovereign wealth fund reallocates towards sustainable debt, they aren't just buying a lower carbon profile. They are securing a seat at the table of a new financial infrastructure. Green is the new prime. This creates a widening gap between those holding legacy industrial assets and those positioning for the emergence of the programmable financial grid. The market currently treats ESG as a peripheral reporting standard. Capital, however, is treating it as the primary gatekeeper for future liquidity, and those two positions cannot coexist indefinitely. To understand the new green financial system, we must stop looking at the solar panels and start looking at the incentives driving the institutional flow. The moral framing of ESG exists because it is effective communication strategy. But the capital underneath that framing is following a different logic, one that is mechanical, not ethical. This new architecture is emerging against a backdrop of historic monetary expansion, followed by the most aggressive tightening cycle in decades. The liquidity environment has been engineered, not discovered. As real yields fluctuate and the cost of capital remains structurally higher than the post-Minus 2008 average, the net liquidity environment has become the primary filter for institutional survival. Consider this, we are entering a window where trillions in corporate and sovereign debt must be refinanced at significantly higher terminal rates, a structural pressure point unlike any in the post-QE era. In this environment, liquidity does not flow equally, it seeks the path of least resistance. Currently, that path is being paved with sustainability-linked bonds and green-certified paper. These instruments often carry a Greenium, a lower yield that issuers are willing to pay in exchange for guaranteed institutional take-up. The price of compliance is already embedded in the structure. An issuer pays a premium to be inside the system. That is not market dynamics, it is the fee structure of a gated architecture. The access cost is embedded in the yield differential. The debt rollover window amplifies this dynamic. As trillions refinance at higher terminal rates, the Greenium becomes a structural lever, rewarding early compliance and penalizing deferred transition. The fiscal expansion of major economies, through initiatives like the Inflation Reduction Act, acts as a massive liquidity injection, disguised as industrial policy. This is not just a subsidy. It is a structural incentive for capital to rotate out of brown sectors and into the new green grid, a countercyclical force operating beneath the surface. This fiscal monetary synergy keeps liquidity flowing into specific corridors, even as the broader economy faces tightening. The channels are not random, they are engineered. The global central bank move towards CBDCs and integrated ledgers provides the structural implication. Liquidity is becoming conditional, access depends on what you hold and how it is classified. Capital is no longer a neutral tool. It is being re-architected into a programmable asset, where green compliance becomes a prerequisite for accessing the discount window or the repo market. The historical precedent for conditional liquidity is not new. The mechanisms of financial exclusion have been deployed before in trade sanctions, in correspondent banking restrictions, in capital controls. What is new is the granularity. If we look at the signals from the largest allocators, the positioning is unmistakable. BlackRock, Vanguard, and State Street have fundamentally integrated ESG scores into their risk modeling engines. This is not a PR move. It is a defensive hedge against stranded asset risk, pricing in the probability that non-compliant assets will eventually suffer a liquidity collapse as the regulatory net tightens. The ETF dynamics reflect this sector rotation clearly. Institutional inflows into climate transition funds are outpacing traditional broad market growth on a relative basis, and that gap is widening. This is a basis trade on the future of regulation. These institutions are front-running the inevitable moment when green compliance becomes a mandatory reporting requirement for every publicly traded entity in the G7. We are also seeing the rise of green collateral in the derivatives and repo markets. Sophisticated capital is starting to treat certified green bonds as superior collateral compared to standard high-yield debt. The reason is reflexivity. As more institutions adopt green mandates, liquidity for green assets increases, making them more stable and less prone to gap risk during a volatility event. The interpretation of these signals is clear. Smart money is not waiting for the transition to be completed. They are building the plumbing today. They are creating a closed-loop liquidity system where only clean assets are eligible for the highest tiers of the capital stack. This is, structurally, a two-tier global financial system. The significance of that observation extends beyond investment strategy. A two-tier financial system is also a two-tier social system. The architecture of collateral is the architecture of access. The derivatives market provides the most honest view of this structural shift. We observe a growing delta between the implied volatility of green-indexed assets and traditional industrial benchmarks. When market stress increases, the gamma exposure on non-ESG compliant assets tends to spike more violently. The market-making community is already pricing in a liquidity penalty for assets outside the new architecture. The liquidity penalty is not announced. It is not in any policy document. It emerges from the aggregate behavior of risk desks, each making locally rational decisions that produce a globally coordinated effect. On-chain behavioral shifts and stablecoin supply dynamics hint at a broader move toward traceable capital. As stablecoins become more integrated with traditional banking, the emphasis on clean coins is growing. This is the digital native equivalent of the green bond, assets whose history and environmental impact are verified on a transparent ledger. The logic of compliance is migrating into the base layer. Supply shock dynamics are also emerging in the carbon credit markets. Sophisticated traders are using long-dated options to bet on the scarcity value of high-quality carbon offsets. This is not philanthropy, it is convex positioning. As the green financial system scales, demand for these credits will be mathematically forced higher by institutional mandates, creating a structural asymmetric upside. The risk asymmetry here is profound. Holding legacy, non-compliant assets today is essentially betting against the entire regulatory and institutional apparatus of the Western world. The expected value of the new green architecture is structurally skewed to the upside, not because it is morally superior, but because it is being mandated by the entities that control the supply of money itself. That is not an opinion, that is the operational architecture. What Bitcoin represents in this context is an asset that sits outside the compliance perimeter, its value derived from the absence of institutional dependency, not from its endorsement. That distinction becomes more meaningful as the programmable grid expands. The larger the compliance perimeter grows, the more structurally significant the assets outside it become. This is the asymmetry not priced into conventional risk models. Institutional frameworks are optimized for systemic participation, not for accounting the value of systemic independence. Navigating this environment requires a shift from emotional reaction to structural awareness. The first principle is liquidity awareness, knowing which assets remain eligible for the highest tiers of the capital stack. You must identify which assets are likely to remain prime in the eyes of major central banks and asset managers, before that designation becomes obvious to everyone else. This is not about following the crowd into overpriced green tech. It is about identifying the assets that will serve as collateral for the next decade of credit expansion. The second principle, adopt a countercyclical approach to the narrative. While the headlines focus on the climate crisis, the rational actor focuses on the incentive crisis. Positioning should be grounded in where the fiscal and monetary subsidies are flowing. The state and the banks have designated the new grid as the priority. When institutional capital and sovereign policy align on a single direction, the path of least resistance runs directly into that infrastructure. The third principle is risk containment, avoiding the liquidity trap of stranded assets. Traditional industries lacking a credible transition plan may look cheap on a P/E basis, but they are value traps if the institutional bid is permanently removed. Strategic positioning means staying on the right side of the incentive gradient, not the sentiment gradient. This is not a matter of choice, it is a matter of architecture. The global financial system is being rebuilt to ensure that capital is directed towards specific systemic goals. You can either understand the new blueprint and position yourself within its framework, or you can watch as your legacy capital is structurally devalued. The system does not wait for consensus. The architecture is not hostile, it is indifferent. Indifference is more dangerous than opposition because it offers no appeal, no negotiation, and no exception for those who arrived late to the structural understanding. This is 21 Protocol, where capital analysis serves a single function: structural clarity before positional commitment. Freedom is not a feeling, it's a structure. If you don't build yours, they will build over you.